So the next problem is this. It's an export order problem. So it says a manufacturing business produces its product at a total cost of 17 rupees per unit and sells at 20 rupees per unit. It has a normal production capacity of 50,000 units per annum and budgeted costs at this level are this numbers. Okay. So they have not told like what is the percentage of capacity, but they have given some numbers. So direct material is 3 lakh, direct labor is 2 lakh, fixed cost 2 lakh 50,000, variable cost is 1 lakh. So they want us to calculate the current break-even sales value. There is a fall in demand in local market and orders are expected for 35,000 units only. Okay, I think so. This should be the full capacity. The sales manager has established that an export order for additional 10,000 units could be negotiated. Okay, could be negotiated at a special price of 14. So the price would be like 14 rupees and he could bring 10,000 of unit sales because 50,000 is a total production capacity. It seems 35 is already being used. So still there's a spare of 15,000. That 15,000 could be used to produce or meet this export order. He has also established that a second order of 4,000 units, modified units, could be obtained at a special price of 13. So he's bringing another order also for the balance capacity. The modifications would reduce the cost of direct materials by 1 per unit, but would increase the direct labor and variable expenses costs by 25%. So these information are only for this 4,000 units. Make necessary calculations and prepare a statement showing the effect of sales manager's proposal. So you don't need to work out the profitability for 35,000 units. That is not our consideration. Our consideration is whether the company will make any money in terms of this 10,000 units and in this 4,000 units. Okay. So that's about the concept here. So we'll start. So we'll start to work out this problem. So the cost of the product is 17, selling price is 20, normal 100% production capacity is 50,000. These are the costs. So this 2,50,000 and this 2,50,000 of fixed cost will always remain the same whether you produce or not. So this will be fixed. The other numbers are per unit variable numbers. So first we'll try to find out the break-even sales volume. So that's what they are asking. So we'll find out that. So to find this, we have to work out the marginal costing statement. So it's going to be direct material, direct labor, variable cost. So they're asking for sales volume. Okay. So sales volume could be units. Okay, volume is units. So we'll find out sales. So sales is 20 rupees. And these elements we have to divide it separately. So this 3 lakh amount is for 50,000 units. And direct labor is 2 lakhs. And variable cost is 1 lakh. So we can get these numbers. We can try to solve them. So now we can get a contribution per unit So contribution per unit is 8. And thereafter we require to find out the BP sales volume. So the formula would be fixed cost divided by so fixed cost is 2,50,000. So this is units. Okay, so this is in units, and if you want in terms of amount, so we'll find out in terms of amount. In terms of amount, it's very simple. You have the break-even sales units, multiply that the selling price, you will get the amount. So this is the break-even sales in amount. So done. So we have finished both in units as well as in amount. So let's get the question thereafter. So the company still has 35,000 units they are selling, and they are getting an additional order for 10,000 and for 4,000. Okay, so we have to work out what is the profitability for the existing number of units. Okay, so why do we need to do that is because existing units profitability. So why we need to know that is we need to know whether at least we are recovering the fixed cost or not. Okay, so fixed cost is recovered or not, we should know. So we'll work out that. So we can put total variable cost is 6 plus 4 plus 2, that comes to 12. Okay, so this is the contribution per unit. What is it? It's in terms of amount. So this number is in terms of per unit. This is also in per unit. In terms of amount, we could easily multiply by the numbers. So we have 8 is into 35,000 units. Okay, and our fixed cost is 2,50,000. So we are recovering the fixed cost. Okay, so the fixed cost is recovered and the existing company itself is in profit. So the existing company is in profit. So the next step is so we can just write a note. Okay, note as the company has recovered its fixed cost, hereafter the company can price minimum at variable cost. Okay, so they can even price at variable cost itself, they could price. Okay, so even that is quite possible. So we'll first find out what's the export order. So export order number one. So they have an order here. So let's get that data. So the negotiated price is 14, and okay, and thereafter there's no much change. Okay, the contribution per unit is 2. So they have made a contribution here. So we just have to multiply 2, which is a contribution, into the number of units. The units is 10,000 units. Okay, so this amount, so 20,000 is their contribution here. It's not per unit, and fixed cost is already recovered, so that becomes 0. So the total profit from export order is 20,000. So the concept is, again we can put a suggestion as the export order brings in profit of rupees 20,000, it can be accepted. Okay, so that is a suggestion. And let's get the second export order. So this one is export order number 2. So the second export order is for 4,000 units, and the selling price is 13, and variable cost will increase. He says there are some changes here. The modification would reduce the cost of direct material by 1. So direct material value was 6 earlier, so that we can reduce by 1. And he also says that that direct labor and variable cost will go up by 25%. Okay, so we can put it as 125 percentage, right? So if you want, we could show it separately. We could even show it separately like this, or we can also, I think we'll show it separately so that you'll get a clear picture. Okay, so direct material is 6 per unit. From that 6 we can reduce 1. From that 6 we can reduce 1. Next one is direct labor is there. So direct labor and variable cost would go up by 25%. Okay, so we can just take this number 4 and 2. So we can solve it. This will be 5. This is also 5. This is 2.5. So the new contribution would be 7.5. So the question is, the contribution is 7.5. How many units we are selling? We are going to sell 4,000 units, okay, at 7.5. No, the selling price, I think it is only 13. Okay, so we have to direct this by change this to 13. Okay, still it makes a contribution. So how much amount of contribution are they making? Making 0.5 into 4,000, so that becomes 2,000. So again, fixed cost is 0, profit is 2,000. So we can say, as the export order brings in a profit of 2,000, it can be accepted. So both orders can be accepted, and all the orders, okay, if the existing profitability alone is 30, if they accept order number 1, it will go to 50, and if they accept the order number 2, it will go to 52. Okay, so this is about the calculation here. But in some questions they will ask you your opinion. Okay, so you have to tell whether it's like proper or not. Okay, so one, export, the price given to export order cannot be given on a continuous basis, as when there is more local demand, it is much profitable to sell domestically. So that's our first point. The second point would be the foreign buyer might sell the same product in local market, thus affecting our sales. So he might buy goods from us and he might sell in the same market itself. So what happens here is, there's a problem of, we are selling at 20, and if they sell at more than 14 or 13, then our company would be at a loss. Okay, so that would be a problem. The existing buyers will get upset if they come to know that we are selling at low prices. Okay, we are exporting at low prices. Okay, so the existing buyers can get affected here, so that can be a problem. And the last problem can be if cost goes slightly above the existing cost, then export orders might become unviable. So unviable means it's like it can become a, it won't be like very much profitable. Okay, so ensure that you also understand the uh, uh, theoretical side of the question, so that it's like quite you can write a better answer. Okay, so the question can ask you to give your opinion or comment, so depending upon the marks you try to give your opinion comment. So this is a nice question, so we'll move on to the next one. So the next one is a process question. It's from ACCA exam. It's called as further processing decision. Usually this question would come in process costing, but sometimes, okay, sometimes this kind of questions can also come in management accounting. Why? Because management accounting is very general in nature, so these kinds of questions can come in uh, management accounting also. So let's work out. We'll start from the required. You can read along the cursor. Okay, so calculate and conclude whether any of the products should be further processed in division B in order to optimize the profit for the company as a whole. So which products can you further process and which you should not process? So that is the kind of question they are asking. And let's see the full question. Okay, so division A, there is a division called as division A. So division A produces a product, okay, which are L, M, and S. Think they are caps L, okay, caps L, caps M, and capital S. So they produce this, and these are produced using a common process. Okay, they are using a common process, and then each of the products can be either sold by the division A to the external market at split of points. Either they can sell it as LMS, or they can send all these products. Okay, they can send all these products to another machine called as division B. So division B they can send. In division B, it will be further processed. So this is called as, once it is processed, it's called as LX, MX, SX. Okay, so these are the products. So he has also given you some data. He says in November 2013, which is a typical month, division of A's output is as follows. So this is the output, and the market selling price per kg for the products both at split off point and at the further selling price are also given. So L could be sold at this price, sorry, LMS could be sold here, LXMXSX could be sold at this price. Okay, and he also says that the specific cost, okay, there is some individual processing cost to convert them at division B is 0.5, 0.7, and 0.8. Okay, further processing leads to a normal loss of 5% at the beginning of the process for each of the products being processed. Okay, so not all the units could be sold as it is. Some of the units could be lost. Okay, so first we'll find out the profitability or the sales value of LMS. So these are products and these are kgs we need, and we need to have selling price. Okay, selling price per, I think it's kgs per kg. So we have 1200 kg, 1400 kg, 1800 kg. So these are the kgs, and this is the selling price. Selling price is 5.6, 6.5, 6.1. Okay, so this is a sales value. So now we have to find out the sales value. So this is a sales value at split off point. Okay, so if you want, you can give a name for it. We will copy the same and we will work out for okay after split off point. So the kgs actually will not be the same, so they will lose its value. So here there will be some normal loss. So the normal loss is 5%. So this number into 5%. So this is the normal loss, and the output would be, so this is the input is this and output is this. This is what we could sell in the market. So 1200 minus 60. So you can find out for all the numbers. So this is our output. So what would be our selling price? Our selling price is these numbers. Okay, so let's get the numbers. The numbers are 6.7, 7.9, 6.8. So we got a sales value. So we got two sales value here. So one is this one and the other one is this one. Our job is very simple. Find out which has the highest sale value, so that you can do. So L or LX has a higher value, so further process it. M or MX, which has a higher value, MX, so again process it. S, okay, sorry, I think we can't do that. Okay, we still have a little bit of problem. Okay, I think we forgot the variable cost. So there's variable cost per kg is there. So variable cost per kg is 0.5 for LX, then 0.7, then 0.8. So now you get the profit value. So profit per kg, I think you can put. So profit per kg would be 6.7 minus 0.5. So we got the items. So should this variable costs be for the input unit or for the output unit? Okay, C has given it for output units only. So 0.5 per kg of LX. So this is what LX is. Okay, so we have to find out for this only. Okay, so when we multiply the profit per unit into the output, it is like automatically computed. So we'll get the answer. So we got the answer. We can now compare. So which is now high, L or LX? LX is still high. M or MX? MX is still high. S or SX? S is high. Okay, so we can say so further process and do not further process. Okay, so the ones which has to be further processed are L comma M, and which something that should not be processed is S. Okay, so this is our suggestion. So that's about this sum. This is a very small sum, but they have given 10 marks for this sum here. So